This is Michael DeVille coming to you from beautiful Phoenix, Arizona. It's the 2nd of June, 2021. Now, lots of things in the news. I'm going to focus on the economy, the inflationary environment we're in, and how this affects us in real estate investing. So let's get right to it. If you'll bear with me, let me get to my slides. I want to talk about the economy. The economy is really one of the big components for us. Now, if you recall, I've been talking about the economy for like the last year. It's one of the things I like to watch. It certainly affects the real estate environment. It affects our investing. Last December, Goldman Sachs came out with their 2021 forecast, and they made a pretty bold prediction. They thought the first quarter of 2021 would improve, and we could see a 5% GDP. Now, 5% GDP is a really, really good number. A lot of the consensus for the economists thought there's no way we're going to get that. They thought it'd be somewhere around 2.5. But no sooner did Goldman Sachs come out with their forecast than the stimulus was passed. And I thought to myself, I think we can do probably better than that. And that's on our videos. And of course, we got to 6.4% for the first quarter of 2021. That is pretty astounding statistics. That means the economy is just on fire. Now, Goldman Sachs goes even further than that, and they think the second quarter, which is what we're in now, could get as high as 8.5%. If all the stars align, I think we might even see double digit because everything is doing exceptionally well. If you're just paying attention to the news, there's shortages absolutely everywhere, and businesses and corporations are earning profits, and business is brisk. Now, just got this today. You can see this S&P earnings revisions are all very positive. You can see how the economy dropped, and then when it bottomed in April and May of last year in 2020, and it was one of the shortest recessions we've ever had. It was just brutal, and it was very, very broad. But it was short, thank goodness. So we came and we just skyrocketed right back. You can see we slowed down a little bit. But here we are in 2021, and the upward revisions are underway. The S&P 500 earnings are surprising absolutely everyone. They're strong, and there's no indication of them slowing down. Now, in the next one, you can see this has been going on for the last 4 quarters. This is surprise to the upside. Now, why do we say this? Why are we concerned about the economy? Why are we concerned about earnings in the S&P? Well, when people are working and when the confidence is high that their business is good, that there's demand for their products, there's demand for work, there's demand for labor, people are more willing to go out and spend. And obviously they're spending now because we're seeing that there's shortages around. It's hard for you to find a refrigerator or a dishwasher. Washers and dryers are hard to come by. Drywall is hard to come by. Such little mundane things as electrical switches. Air conditioners are hard to come by because there's demand for this. And I'm going to tell you what there's demand for is the U.S. skilled worker. He is doing really, really well. They are doing well. Our men and women that are working in our workforces are in demand. They're demanding more wages. They're getting more hours worked, and they're willing to spend their money. It's a virtuous cycle that we're in. Now, when you're having a virtuous cycle where we're feeding on each other, is getting better and better and better, it's almost impossible for you to have a housing crash because things are very, very good. So I see a bull market across the United States in every hamlet and village, small town, small city, large city. I think we're going to see a boom in real estate. Prices are going to explode to the upside. The only thing that would stop that would be a recession, and I see absolutely no reason to think that we have a recession at all. We have shortages and things, and there are demand shortages. So let's just go to my next slide, because the next slide is going to talk about inflation. Now, inflation comes in a couple different components. We've alluded to this in the fact that we have inflation across the board. So let me go to my next slide. You can see you get the CPI, and we are having inflation in core goods. We're having it in food and energy. I went to the grocery store today. You're going to be surprised at how fast meat prices are going up. There's going to be some soybeans are going up, corn's going up, wheat's going up. So all the associated products with that, you're going to start seeing bread going up. They're getting into the pipeline, but they're not necessarily into the finished goods yet that's coming, and we see no slowdown. Now, keep in mind, these things go up and they come down, they go up and they come down. This one is spiking straight up. It's strong. I don't think it's transitory. You're hearing a lot of words about transitory. It's only going to be for a few quarters and it's going to stop. Well, it's got a really strong trajectory. It's got great momentum. I think this is entering a full-blown inflationary cycle, which is going to take a while to work its way out. And it's going to go considerably higher from here. So I think this is something you're going to have to get used to. So anything that you want to buy, I think you should buy now. It's going to be affecting virtually everything. It's pervasive. It's across a lot of asset classes. Now, this is from Economic Cycle Research Institute, from one of their conferences that they did. And this is the U.S. Future Inflation Gauge. Now, the U.S. Future Inflation Gauge bottomed in April of 20. Now, that coincides with the bottoming of the recession. And of course, recession kills inflation. So the moment that recession ended, inflation started. And this inflation has been going straight up, not straight up, but it's been going up consistently ever since. Now, their work precedes the CPI. You can see that's just slightly ahead of it. And the CPI is also going up and it's starting to spike and it's getting into virtually everything. But what you don't see here is this. You don't see it rounding out. You don't see it slowing down. It's continuing on its trajectory. There's a lot of momentum behind it, and it's a cycle. So I think we have a full-blown cycle coming. There's no hint that it's slowing down. This is something that comes and goes, but I think this is going to be a pretty strong cycle, and I think you need to prepare for it. Now, of course, one of the things when we talk about inflation is purchasing power. We're going to talk about that in just a second here. But here's one of the other things that I'm concerned about is getting into the foodstuffs. We're seeing it in corn, wheat, and of course, look at soybean futures. Just look at this spike. This spike is in virtually all asset classes. You can just see this spike. You're going to see it in housing. You're going to see it in lumber. You're going to see it in steel. You're going to see it in gold. And a lot of the real assets have got this spike. And of course, this soybean's going to go into the feedlots, which is going to see, you're going to see pork and beef prices go up. You're going to see poultry prices go up. And I think that's going to spill over into a lot of the all your foods because it's not here yet. And you're going to start seeing that. And then we also have shortages, and the shortages are causing demand and inflation in their asset classes. Now, cars have a shortage of chips. That's in the news. They can't deliver these cars because they're full of microchips, and we don't have enough microchips. So what does that mean? It means that secondhand cars are soaring in price. Again, it's another real asset, and these are going up at a phenomenal rate. Notice the spike. This spike is in absolutely everything, and there is no rounding out. You don't see this slowing down. You don't see it coming to an end. It just continues on and on and on. Now, it's not going to continue. It's going to get to normal. We cannot continue with this business as it is because it's not sustainable. In my business, it's just on fire. We're getting multiple offers on virtually everything. This is not normal, and it's not sustainable, and it's going to slow down. I suspect that probably next 3 or 4 or 5 months, it's going to slow down. And people are going to say, oh my goodness, it's crashing. It's really slowing down. It's going to slow down. Yes, it's just going to normal. Normal is very, very good, but we are not going to have a housing crash. Not going to happen. That's not going to happen. The only thing that's going to stop a housing crash, completion of a cycle, or a very, very, very vicious recession. I see neither one of those on the horizon. I think that things are doing very, very well, but we do have inflation. And of course, when you're my age, when we have inflation, we need to be concerned about protecting our purchasing power because things are going up. And we've had benign inflation for the last 20 years, less than 2% annualized. I mean, it's been really, really benign. And in that benign inflation, in over 20 years, we've lost almost 50% of our purchasing power. What's going to happen if we get vicious inflation? So you better have some inflation hedges in your portfolio. Talk to your financial advisor. If we can help, let us know. We're really, really good at this. But I'm going to give you this hint that single-family rentals are one of the best inflation hedges a small investor can possibly have. The price of the properties goes up, protects your values, and of course, rent gets readjusted and protects your purchasing power. This is just a wonderful, wonderful thing to have, particularly in a great market city, United States. It's just very, very good. So we've got we've got demand inflation, we've got CPI inflation, and we've got an economy that is doing exceptionally well. So what does this mean for all of us? Well, what does it mean for us as real estate investors? It means that prices of homes are going to continue to rise and get higher and higher and higher. Now, this looks like we're way above where we were in a spike. This is the bubble of 2006. You will notice that this is a process. It's not like a spike. It's a process. And it looks like we are way above where we were at the peak of the bubble. And it scares people. This, however, is not inflation adjusted. And I'm going to tell you, even in benign inflation, it affects your purchasing power. And just now, literally in February of 2021, we equaled what the bubble was in 2006 at the very peak in inflation adjusted dollars. It took 16 years to do that, 15 years in inflation adjusted dollars. And I think we are going to go way above that bubble and go into another bubble of our own, but it's going to be much higher. I think we're going to go here. I think you're going to be astounded at how high prices are. But I think in the cycle, we got 3 or 4 years to get there. In the meantime, fortunes will be made. Now we're just here. You have the opportunity with which to accumulate a nice portfolio for yourself. This is actually called the accumulation phase. And this is one of the greatest times in the cycle for you to accumulate properties. And it's unfolding right in front of you. This is going to be one of the greatest real estate bull markets in my lifetime. And it's unfolding right now. Now, we're only here. Now, this is the accumulation phase. This is the explosive phase. Now, once you start accumulating here, we're probably going to want to start selling some of our portfolio when we get up here, because I think the difference in price from here to here is going to just astound most people. Now, I was around in 2006. This is going to be my fourth completion in the cycle. So now in 2006, the people that got in trouble in 2008 and 2009 and 2010 were the ones who were over leveraged. They were the ones that had a lot of financing on their properties. Now, I certainly think that you should be financing through this accumulation phase, because we're going to be paying back in much cheaper dollars, because we've got a great economy going, we've got inflation, and we've got an inflationary shortage going on, which is causing demand. And then, of course, for finished products like finished homes, there's a great demand for these, particularly in the great markets in the United States. Florida, Texas, and Arizona, the demand is just amazing. So if you buy 20 properties during this accumulation phase, and then we sold 10 of them during the explosive phase and paid the mortgages off on the other 10, you could go up here into Bubble Terry, complete, and you'd have 10 free and clear properties. And you can complete to the other side, and you can go on vacation. You can sleep well at night because your properties will be free and clear. And you have income coming in because they're also basic shelter. They all need everyone needs a place to live. And your rent will keep coming in. So we want to make sure that we're able to take care of the debt. We want to be very careful. We have strategies for this. And we're all going to make a fortune. So if you find that your retirement accounts are just a little less than what you'd like them to be, you have an opportunity staring you in the face. Would you do something about that? So ask your financial advisors to reach us. We're more than happy to work with them. Now, this is where I ask you to give me a thumbs up if you like my video. Please subscribe. That helps us with our marketing. And if I would like you to succeed, I would like you to become wealthy. I would like you to have income that you can retire with dignity, retire with all the money that you possibly want. If I can help in any way, I certainly will. Reach me at michael@michaeldeville.com. I want you to succeed. I want you to do well. It just would give me the greatest pleasure to hear back from you saying how well you've done. My very, very best to you. Bye-bye.